Hi, Lee Phillips here. I'm an attorney. Don't hold that against me. I want to talk about something called shifting income. It's one of the, I'm going to call them three basic tax techniques. One is shifting income. We're going to talk about it. Two is postponing the tax. And three is changing the nature of the tax. Basically, all tax planning falls into one of those three categories. Let me talk about shifting income for 2 seconds. What that means is we have a different person pay the tax than actually earns the money. We shift the tax burden to somebody else. It was very common. It's getting less common because they've decided this is something that the rich people do, and so they have clipped the wings of the shifting possibilities by implementing what we call the kiddie tax. And we have another video on kiddie taxes, where the child pays the tax at dad's rate. Don't you love that one? At any rate, we earn income and then we make somebody else pay the tax. But you cannot make somebody else pay the tax on earned income. It has to be passive income. A number of years ago, like 40 years ago, this concept, shifting income, was around. And I remember the local steel union, the financial planner guy, went into the steel union, and he actually got the steel company to say, okay, dad makes his $50,000 a year. Well, we're only going to cut a check for dad for $30,000 a year, and we're going to take the other $20,000 and we're going to divide it amongst dad's 4 kids. Each kid gets $5,000. That way the kid pays $5,000 earned income at his rate, or passive, they called it. Not really. And daddy only pays tax on $30,000. Not a bad deal, huh? And they set up a whole payroll and everything else. And a couple of years later, the IRS came in and said, no, we don't shift earned income. So how do you get passive income? Well, you have daddy. He owns the construction company. He's the doctor. He's the lawyer, whatever. Daddy has stuff that he has to have in order to do his work. I mean, I'm a lawyer. I got a desk, file cabinet, computer, and Xerox machine, one of them new fang-dangled fax things. And I move the equipment out over into a second company, not my legal company, but a second company. Then the second company rents the equipment back. Daddy moves the backhoe out of the company into the second company, and then the second company rents it back to the operating company. Well, who owns the second company? The kids. And so daddy earns money with the backhoe company, pays the rent for the backhoe. I mean, he's got to have a backhoe, right? And then that money is paid down to the kids, the owners of the second company. Works well for asset protection too, because if daddy gets sued in the backhoe company, well, it wasn't the backhoe that caused the problem, it was the operator of the backhoe, undoubtedly. And so the operating company gets sued, but they can't take away the rented backhoe. Can you see how it works? So it's a good asset protection technique too. Now, because of the kiddie tax, the kids now basically have to pay tax as if daddy had taken it anyway and paid his income tax on it. So it's been clipped out a lot. Wait, there's one issue. What happens if you're supporting mom and dad? They're getting a little older. You slip them a little money on the side, help them out. Mom and dad, they're not kiddies. They old people. They're not subject to the kiddie tax. So we can shift all the income we want to mom and dad and help them out. That way you're helping your family member, your kid or your parents, with a dollar that wasn't taxed nearly as much. And if you can help your family members with a dollar that isn't taxed nearly as much, is your family going to get ahead financially a little bit faster? Yeah. So take advantage of this concept called shifting income. In fact, anybody can be the recipient of the shifted income. It's just the kids, the kiddies, under 18, under 24 if they're students, the younger folks that have to worry about the kiddie tax. But the older, the young married couple, they can shift income. You can shift income to them all day long. They don't pay the kiddie tax. So it's still an important concept. Have somebody else pay the tax. Dad has $1 million in stock. He gifts it to the children. Then the children pay the tax on it. And they could even be older children. Now, I did this a lot when I was younger, and my kids were kiddies. Well, and I did it with rental units. I'd put the rental units in the company that the kids owned, and then they'd get the rent. Well, my kids got to be successful enough that they said, "Hey, Dad, time out. We don't want this income anymore. It's throwing us into increased tax bracket. It's a big problem for us." And so basically now I still have the rental units in the company, but as the manager of the company, I take the income. So it's a way of controlling taxes, shifting income.